Hello, and a warm welcome to our investors listening in to the very first episode of Catalyst's inaugural podcast, The Real Assets Roundup. I am Kerry Sattery, the head of distribution here at Catalyst Fund Managers, and I'm absolutely delighted to be able to kick off the first discussion today with some very bright minds, which are none other than my colleagues. So firstly, we've got Marcus Erlang joining us. He's the portfolio manager on Catalyst Hedge Strategies. We've got Theo Freyson, who is not only an analyst on the global listed property strategies, but also a co-portfolio manager on our recently launched global listed infrastructure fund. And finally, last but not least, Bontle Siema, and she joins us as an analyst representing the South African listed property capability at Catalyst. Welcome, everybody.
Thank you so much. Thanks for having us.
Hi, Kerry.
Right, so it is our first podcast, so I wanted to actually introduce something new to the scene, and I want to call it the first sip. And basically, I want to be that nosy person and find out what you're drinking this morning. So, Theo, what's in your coffee cup?
I am drinking a flat white, I hope.
Nice. Bontle, what's piquing your interest this morning?
So I'm not a big coffee person. I get the jitters, but I am having a apple and ginger juice. So the ginger is my kick for the day.
Love it. I thought that was a bit of a matcha influence.
No,
there,
it's
so
definitely
bit of a
quite
plot
green,
twist.
but definitely just apple ginger.
Lovely. And Marcus?
Very Cape Townian of me, but it's a flat white, but with almond milk.
Another flat white. The reason I ask this is people's coffee orders often indicate the mood or their personality, but I'm actually taking a bit of a reach and seeing if it relates back to the way you invest. Because what I'm seeing here, I'm a strong black Americano, a bit of a quick hit gull, but flat white's quite interesting. It's giving more of a long brew feel to it, and I'm quite curious to know if that relates back to the way you invest. So let's find out. Today we are here to talk about property. We're in 2026, and depending on whether you're coming from a global or a local lens, property can look quite different. I think if we think back to where we were last year in the SA space, it was really the start of a new growth cycle coming through, and that momentum's carrying through into 2026. On the global side, however, we've obviously had a lot of noise in the system on a macro front, a lot of uncertainty offshore, and perhaps the global asset class got a bit lost in the mix there. So it'll be very interesting to see, where those selective opportunities are this year, and to see if there are more tailwinds to come. But enough from me. I obviously brought all of my experts here for a reason. There's a specific reason I asked each of you to be here, one from global, South Africa, and our alts capabilities, because I understand that as portfolio managers, you ultimately have ultimate discretion over your individual portfolios, but it's a team ultimately that sits behind these investment decisions, and there's a lot of overlap and a lot of healthy debate that happens across all of the capabilities. So I want to unpack today kind of where the similarities are, if there are nuances, what are those nuances, etc. So let's dive in. I think bring all the listeners up to speed as to where property is. Where were we a couple of years ago? What does the property cycle look like now? And maybe, what's the big shift that's happened between then and now, if there was one? Bontle, maybe you hit us off from a SA perspective.
Thank you so much. So from a South African listed property perspective, we've really moved from a survival state to a growth state now. In 2022, early 2023, it was all about protecting income. Companies were managing through load shedding. Interest rates were rising. There was pressure on valuations. So it's really different now where we're in a growth cycle. The momentum has essentially continued from 2024 into 2025. Operational metrics are different. Interest rates have fallen in 2025. So you really are seeing a complete 180 from your 2022, 2023 riskier times to a more stabilized environment in South African listed property.
Thanks, Bontle. That's really interesting. Theo, on the global side, is it a similar story, or what's happening on that end?
I think if you compare where we are today compared to a few years ago, a big difference is that there's a lot more focus on property fundamentals. A few years ago, macro factors like inflation, volatility in interest rates, and cap rate uncertainty was a driving factor. It was difficult to determine what was a temporary valuation noise versus what is more a long-term sustainable situation, where today income and the growth in the income drives more about the returns that you can see going forward.
Brilliant. Anything to add on the outside of things, Marcus?
Yeah, I think my colleagues have summarized well the differences sort of between SA and global. Maybe if I can answer it a little bit more from a sort of a hedge fund specific point of view. 2022, 2023 was the beginning of the hiking cycle and high inflation cycle. South Africa had a whole bunch of its own headwinds still at that stage, political uncertainty, like Bontle mentioned, load shedding, et cetera, et cetera. So from a hedge fund point of view, 22, 23, going into a cycle where property really comes under pressure, it was about being very selective with the stocks you were, investing in, a big focus on balance sheets and balance sheet strength and the companies that were more, insulated from repricing risk. And actually just being out of the market. I think it was very important to use that tool set that a hedge fund has to be able to be in cash, to limit the drawdowns and to limit the volatility. And then you fast forward probably to 24, 25, where there was a far more optimistic picture, especially within South Africa, where interest rates started to come down, political stability, load shedding has ended, where you actually were... It didn't really even matter what you were in South Africa. You just needed to be in South African property. So over the last, two years, call it, just being overweight SA exposure and making sure that exposure was actually in the market rather than in cash was delivering a lot of your absolute returns.
Brilliant. That's such helpful context for us to actually navigate the rest of this conversation. I think the one thing that was really coming through, especially on the SA side, was the income factor and actual income growth. Bontle, with South Africa now, with inflation moderating or cooling and lowering to 3%, companies are guiding still for mid to high single-digit dips growth. For you, looking at the SA universe, how important is real income in your considerations when you're putting your bench together?
So it's very central to our conviction. So with companies that are guiding to dips or distributable income per share growth of greater than inflation, that's really meaningful for investors to capture that real income growth going forward. From a lease escalation point of view, you're still seeing 6% or higher lease escalations across the board. So that is already higher than that 3% point target that the SARB has. Then interest rates are falling. So over 2025, there's been a 1% reduction in your interest rates or your repo rate. So that's already flowing through from a balance sheet perspective. You're already seeing the interest line reducing from that point of view. We're seeing positive reversions from your retail and logistics sectors. So that really has been positive from a NPI or net property income point of view, and that's been quite beneficial for the property companies. But companies are seeing lower or rather compressing cost margins from this. So there's no longer pressure from a diesel cost or higher electricity cost from that point of view. And what we're seeing is also property companies are investing in solar PV initiatives. They're investing in better water initiatives. So that does filter or flow down to their profitability lines as well. So from a 3% point target, we're seeing higher guidances and in some cases, companies upgrading guidance. So that's really good for investors from a real income growth point of view.
If I can maybe just add something to what Bontle is saying, I think it's something we get from a lot of investors or people querying the asset classes saying, how are these companies able to sustainably beat inflation from their distributable income growth? Surely it needs to moderate. And probably in a few years' time, it will start to moderate. But what you have at the moment is a very, very robust, top line growth. What Bontle mentions is the escalators still being, 5 to 6% in many cases. So it's north of inflation. A lot of the time, administrative costs can be, contained in a low inflation environment. So you've got operating leverage at the top line, and then below the line, you've got the financial leverage effect of lower interest rates. So that gives you almost like turbocharged growth that can exceed inflation in the short to medium term.
Very interesting. I think also maybe on the global side there, I mean, AI and tech, it's a lot more flashy and in the headlines. Do you think income growth is being underappreciated globally?
I definitely think so, Kerry. I think a lot of investors think of real estate, maybe it's just a yielding asset, delivering, day one yield. But when we flesh out and we often present to investors like the growth outlook, they're often surprised. And as Marcus has mentioned, it's a combination of some top line growth, Fundamentals are generally healthy. There's not a lot of supply. One kind of benefit of inflation has been construction cost inflation. So it doesn't really pencil to bring in new supply. So as a current landlord, that gives you pricing power. So we're seeing decent rental growth. And then a lot of the balance sheet pain has been taken. Interest rates, during COVID bottomed in developed markets. The US 10-year was at like 50 basis points. Today, at a 4% yield, interest rates spreads have moderated, and the financing market is open. Banks are lending. Almost all of the developed market REITs have access to the bond markets. They are financing at more normalized yield now. So when you put that all together, today we're looking at a free cash flow yield of the sector of about 5%, just over 5%. And we see that growing at between 5 to 6% a year. And I think people underestimate, if you buy something at a 5 yield and you can hold it medium term, let's say for 5 years, it grows at 5. That really gives you the opportunity to get decent 9 to 10% buy and hold return.
There's a very compelling argument right there alone. You've now touched on balance sheets. Marcus, earlier, you also mentioned balance sheets and fundamentals driving a lot of actually underlying returns. Marcus, with your lens of both the SA and the global landscape, what is the average health, if you can even go there, of balance sheets out there of underlying companies?
So maybe I'll go geographically. I think in South Africa, the companies were far better positioned going into COVID already than they were, say, going into like the GFC 15, 20 years ago. So balance sheets in South Africa are generally healthy. They're in that 35 to 40% range. You've had a cycle recently where share prices have rallied to an extent where companies are able to raise equity again quite accretively. They can either deploy that or, buffer up their balance sheet with a bit of a cash war chest. And it allows them to actually be front-footed going into the next part of the cycle. In addition to that, South African companies generally, they when they do their hedging of their books, they either hedge very short end of the curve or they use structures like caps rather than swaps. So they actually are hedged against a rising interest rate environment, but they can participate in a decreasing interest rate environment, which you have now. So they obviously got hurt quite badly when it was a rising interest rate environment, but now they are actually getting the benefit far quicker than some other regions, in the decreasing interest rate environment. Globally, I think it's a mixed bag. In the US, generally also balance sheets are quite strong. US companies tend to hedge their books very, very far out. So you pay up for that, for the tenor of hedging, which means that the in-place cost of funding in the US was already quite high. So then when interest rates rose, the repricing, the quantum wasn't as big because it was hedged for so long. And B, even if they were to reprice, the rate jump wouldn't have been as bad. That being said, in Europe, I think you still have an issue that, a lot of the companies had, locked in cost of funding at, 50 basis points, 1%, that even though interest rates have cut in in European regions again, they are still far higher than they were going into COVID in the QE era. So I think a couple of the European companies, they have higher leverage, and then they still have a bit of a repricing headwind to come when the hedging rolls off. And then finally, I think in Asian regions, there's just, behaviorally sometimes some nuances there where they do tend to take higher levels of debt. And in the market, if you're a domestic investor, you have a higher tolerance for that kind of a stretched balance sheet. Here, it's higher than our universe average. It's higher than we used to. It's higher than what we like. So quite often you struggle to find value in some of those regions because of the sort of behavioral nuances of having a stretched balance sheet.
It's really interesting to see how many nuances there are just on geography alone, which really lends the case to why active management is actually important, and you need the experts involved to be able to dissect these things on a look-through basis. At Catalyst, we at the heart of things, we're bottom-up investors, but we also live in a world with heavy macro swings going on around us, left, right, and center. So it would almost be irresponsible to not consider macro in some regard in terms of our portfolio construction. So I wanted to actually just understand a little bit from your respective universes, sort of, are there particular sectors that are pulling through right now? Are those driven because of macro tailwinds or structural tailwinds, or is that actually sectors are in favor because of underlying companies that you like? So just quite curious to hear sort of the sectors you're leaning into, those that you're actively avoiding. Maybe let's start with Bontley again on the SA front.
Yeah, sure. So, from an SA point of view, what's really important to highlight is that the companies are not necessarily specialized in one specific sector. So, you do find various subsectors within some of the companies within the universe. So, when looking at a specialized versus diversified, I would say SA leans towards more of a diversified. And what that means is you've got companies that have retail, industrial, as well as offices within their portfolios. So to really just go, okay, I love offices, and you go for an office company, that is a bit difficult within our industry. But we are quite constructive retail. We really do like retail landlords that are operating in your township areas and where trading densities are increasing greater than inflation. So we are favorable those. From an industrial point of view, there are still some supply issues from an industrial point of view, but we are seeing vacancies coming down. Supply issues more from a logistics side. We're quite cautious when looking at companies that have high vacancies within that logistics region. Then moving on to offices. So offices is quite an interesting one. It's not just a blanket effect. So you've got offices that are of a much higher grade versus offices that are of lower quality or lower grades. So your greater nodes, so your P grade, A grade type offices, that's where we're seeing vacancies coming down. So that's really driven by tenants looking for quality now. You really are trying to bring your employer back into office. I mean, think about yourself. Are you really trying to move from working from home into a lousy office that's falling apart? Probably not. You want to move into an office that has better amenities. You want to feel comfortable in office. At the end of the day, we are spending a lot of our time in offices. So that's where we're seeing the trend. People moving from your B, A grade, or rather BC grade, so your lower grade, into P, A grade offices. So we're quite cautious when looking at offices. And like I said, from an SA point of view, it's not picking one sector and running with it. You do need to assess all the risks as each company might have, or the other sectors that you might not like.
That makes a lot of sense. I think on the offices in particular, you're cautious on secondary offices, but I imagine offices aren't the same story everywhere. You've definitely given the South African perspective. Theo, are you seeing similar trends offshore in that particular sector?
Yes, definitely. The one thing I would first just contrast is globally, we have generally a lot of specialization. It's just a much bigger market. There's a lot of companies that specialize in specific sectors. So we look at something around 20 different subsectors, which can be very different in terms of supply demand fundamentals. If you think about a company that just invests in apartments versus one that has data centers versus one that has senior housing, it's different dynamics and different cycles that they're in. When we look at the office sector, a similar thing is happening though, where we're seeing extreme bifurcation, meaning that the prime assets are generating a lot of investor interest. As Bontley said, that's where companies want to be to attract talent. So we are seeing in supply-constrained markets like London or Tokyo or New York at the moment, really strong rental growth, and the people who can develop at decent profit margins. But on the flip side, commoditized offers, B grade, or geographies that are not in favor, you're seeing asset values decline, and you're probably going to end up with some stranded assets, meaning assets that are very hard to let at any profitable rate, probably could be converted to something else like residential, etc. But your question originally was what sectors we like. I think globally, there are a few sectors that are doing quite well in terms of the fundamentals are strong, notably senior housing, specifically like in the United States. You've got a massive tailwind of demographics. So the baby boomers are retiring. They've got a lot of net wealth in their households, pension funds, etc. And they can afford quite expensive, to be honest, like independent care or senior housing facilities. And at the same time, you have a constraint in supply, and the asset price construction cost inflation means that new developments don't pencil yet. And then on top of that, the companies that operate in that in this sector has extreme scale and platform. So they've got a cost of capital advantage to the private market and smaller players. So they're able to grow externally quite aggressively. And so the combination of, double-digit, mid-teen type of organic operating growth, plus the fact that they can grow externally, means that they are delivering really, really exceptional growth. And then something that I think none of us would be surprised by is the strength in demand for data centers. There's obviously longer term some question marks over technological risks. How many data centers will we need? What will the effect of AI or new technology, new chips be, etc. But if you look at the pace at which hyperscalers are putting capital into this, for the foreseeable future, 5-7+ years, you have got a robust development pipelines that are let out to companies that have very strong balance sheets, and we're seeing strong growth there. Organic rental growth in the data center market is picking up, and then also the companies are delivering strong income growth from big development profits that they are delivering.
It really does seem like there's a lot of opportunity out there. It's just understanding, where to find those opportunities. Before we wrap up, I'm going to do a quick fire round. And when I say quick fire, I want black Americano cortado answers. No long brew. You got 30 seconds and then I'm moving on. So it's your lucky day, and I've got one additional unit of risk for you that I'm freely giving to you in your portfolios. Where are you deploying it tomorrow?
I think I kind of already answered that question. I think senior housing is well located, high quality senior housing in the US has got a long runway.
Montle?
I'm big on diversifying my money. So one unit I'd probably split into companies that have township exposure and companies with an offshore pipeline in growing jurisdictions.
And Marcus?
I'll again answer this from a hedge fund point of view, but short, long bonds and long SA-centric small cap properties in the SA property universe.
Brilliant. Okay, we're going to start the other way now. I've got another one for you. Can you think about one view or one statement that you fundamentally believe in that you don't think most of the market believe or have cottoned onto? So, Marcus?
I'll probably say that the risk equation of a risk-adjusted return when it comes to SA property, I think the forecastability of earnings for the next few years and the transparency of earnings and how low the downside risk is to earnings is completely underappreciated by the market. So I'd almost say that the hurdle rate required to invest in SA property right now is probably overstated.
Interesting. Bontle?
Nice one, Marcus.
Did he steal yours?
Probably. But I have another one because I'm always diversifying my thoughts as well.
Nice.
So for me, I would say the market has a little bit of a negative view when it comes to retail, or rather that's turning from a Shein, Temu, gambling being a problem in South Africa. But I think this is a really good opportunity for retailers to be innovative. I mean, there are tools, there's resources, AI is coming through for them to really reduce their cost margins, which is what's causing the pressure now. So I would really say the retail skepticism now is something that might need to turn.
Interesting. And Theo?
I just want to comment on the quick fire nature of the answers.
Yeah, she was on the verge of a flat white there.
But anyway, I think investors underestimate the growth and the real yield component, the real asset component. It's not just a day one yielding asset. It's not just a bond proxy play. So, if there's a spread between yields on day one, people often underestimate the effect of the growth that it can have on a total return play.
And then a final one for you will be, say you're thinking about property again for the first time, or you've previously downweighted your property allocation and are relooking at that in a multi-asset portfolio, for example. What is the strongest reason for investors right now listening in to reconsider allocating to property?
I'll go first because I don't want Marcus to steal my answer this time. But
Smart.
there's really little downside risk priced into the cash flows now. I mean, the sector has turned. Companies are reaffirming their guidances, and some of them are upgrading guidance as well. So I would say that is my answer.
Yeah, I think globally, I would say valuation is an attractive entry point. If you compare real estate versus bonds, we've had a great derate in real estate when bonds moved from 1 to 2% range to the 3 to 5% range globally. But I think compared to bonds, in an inflationary environment or environment where I believe we've moved from a structurally lower inflation environment from, call it globally, let's say we were in a 0 to 2% inflation band, we're probably now in a 2 to 4% inflation band. In that environment, real estate with the ability to grow cash flows really stacks up a lot better than bonds, which doesn't do well in a inflation environment. And then compared to general equities, the real estate is attractively priced. On day one, there's a big spread on income. I think on the S&P 500 now, the dividend yield is something about 1%. And in the developed real estate universe, it's around 4.5%, with about 5%, growth on top of that. So real estate really stacks up well in terms of compared to on valuation basis, both to bonds and general equities.
It was definitely a flat white answer. Marcus?
Yeah, I'll now also take my time with my answer. Now there's no pressure to be quick in this one. Yeah, I'll just say, previous answer and reiterate what Bontle is saying from the hurdle side, the downside risk to earnings. But on the other side of it is what you're actually getting from an IRR package, which is very attractive. In SA, you can still find high single-digit distributable income yields. A lot of them are increasing their payout ratio, so you're getting a very attractive dividend, cash in hand, cash in back pocket. And you add onto that, high single digit growth. You suddenly have, an IRR package in a 1 to 3 year sort of time horizon of 15, 16%. And, in a lower inflation environment, if you look across all sort of investable opportunities, it's getting increasingly difficult in South Africa to get a double digit return. So by able to, get high single digit growth and high single digit dividends, you are actually getting a very nice inflation beating, other asset class beating return. And then like Bondle said, couple that with a low downside risk to earnings. And I just think it's a very attractive place to invest right now.
So I think the Qatar answer there would be in valuations, low downside risk to earnings, and compelling returns profiles. I think
Nailed it.
There we go. But thank you so much for all your time this morning. I really love chatting. I think there's obviously a strong case for both global and SA property at the moment. And I think the other really important thing here is active management. Catalyst turns 25 years this year, which is super exciting. Absolute property experts been managing money since the early 2000s, and real experts in this place and can bring specialized insights. Marcus has also recently reached his 20-year hedge fund capability track record on the QIF. So it's a really exciting time for the business, and I'm really looking forward to having you back in the podcast studio in a couple months' time, and we'll see where the markets move to. So thanks for your time.
Thank you, Kerry.
Thank you.